The labor market is whispering something the headlines aren't shouting, and the reality is shockingly clear once you look past the surface. Jobs are still being added, but not in a way that signals strength. In January, private companies added just 22,000 workers, far below what economists were forecasting. That's less than half of expectations, and it tells us the labor market isn't booming, it's slowing. At the same time, prices for energy, metals, and key commodities haven't just edged up. They've shown renewed upward pressure. Oil prices have pushed higher, various industrial metals are rallying again, and the cost of basic goods from livestock to metals is creeping up. That mix, soft employment growth and persistent price rises, is the exact opposite of what central bankers want to see. I'm John A.G., and this is Boring Money. Today we're going to peel back the layers of what's really happening in the economy, why the Federal Reserve is stuck in an almost impossible policy bind, how this tension is shaping market behavior, and what it all means for positioning in the near future. Before we begin, a reminder, this is educational analysis based on current data, not financial advice. Markets are unpredictable, and your own research and judgment matter. What makes this moment fascinating isn't any single data point. It's the way multiple economic indicators are telling conflicting stories at the same time. The US economy isn't collapsing, but it isn't roaring either. It's somewhere in between, and that's a dangerous place to be, because it forces policymakers and markets to make decisions without a clear direction. Let's start with the labor market. The most recent private payrolls data showed only 22,000 new positions in January, a clear disappointment relative to expectations. Economists had projected roughly double that number, but the actual figure landed far below. Most of the gains came from sectors like education and health services, while industries that typically drive broader employment, like professional services and manufacturing, showed job losses. This isn't evidence of mass layoffs, and it isn't signaling recession on its own. But it does signal that job creation has slowed to a crawl. Job growth at this pace feels more like stagnation than expansion. The official government employment figures for January were delayed due to bureaucratic timing issues, meaning markets have had to lean on early indicators like this ADP report instead. One of the deepest questions now is the economy healthy because GDP numbers are positive, or weak because payroll gains have faltered? On the surface, US GDP continues to post positive growth, but much of that growth comes from capital expenditures, especially on technology infrastructure like AI data centers, cloud capacity, and chip production. When companies like Meta, Microsoft, and Nvidia pour billions into machines and facilities, it boosts GDP figures. But that kind of spending does not necessarily translate into broad-based hiring the way consumer demand does. Strip out those heavy corporate investments, and the underlying economy looks much closer to what the jobs data is telling us. Flat, not contracting, but definitely not expanding with vigor. Here's where it gets analytically interesting. GDP measures total spending in the economy, while jobs reflect sustainable income-generating activity. One can be positive while the other is weak, and that's exactly what's happening right now. Why does this matter? Because the Federal Reserve's mandate isn't GDP growth, it's employment and price stability. Right now, employment is softening. Meanwhile, price pressures in commodities and components of consumer spending remain elevated. That combination ties the Fed's hands. If unemployment were rising sharply, cuts in interest rates might make sense to stimulate hiring. But job growth hasn't collapsed. It's weak, but not disastrous. That means there's no clear justification for aggressive cuts. On the other hand, inflation pressures haven't completely faded. The Fed has paused rate changes recently and is being data-dependent, watching both price and labor trends closely. This puts the Fed in a box. Cuts too soon, and inflation could reignite. Hold measures too tightly, and a slowing job market could bleed into broader weakness. There's no clean way out of this dilemma. Now let's look at price trends. Inflation isn't just a single number, it's a mosaic of different components reacting to different forces. Energy prices respond to geopolitics, supply constraints, and production decisions. Food prices move on weather patterns, transportation costs, and input scarcity. Shelter costs take into account housing availability and interest rates. When prices in energy, metals, and food all show upward movement simultaneously, it hints at deeper structural pressure, not just a momentary spike. That's the backdrop we're seeing now. Commodity indices have been firm, and price signals across raw materials sectors remain stubbornly resilient. The Fed often watches core inflation, which strips out volatile food and energy prices to gauge underlying trends. But headline inflation is what consumers feel when they shop. When grocery bills, gasoline costs, and energy bills are climbing, people notice right away. Herein lies another knot in the policy problem. Markets are pricing in expectations for eventual rate cuts this year, but rising inflation pressures make those cuts harder to justify. The tension between slowing job growth and sticky inflation is real, and it's beginning to show up in financial markets. So let's talk about market structure, not price targets or daily predictions, but structure. the patterns traders watch to gauge positioning, risk appetite, and probability of future moves. In equities, indices like the S&P 500 have been threading critical technical lines. An important trend line that connected multiple lows over many months had been providing support. But recently, the index broke below that trend, retested it from underneath, and continued downward. This isn't a definitive signal that markets will fall forever. It's a probabilistic one. Historical patterns show that in similar situations, markets often continue trending lower more frequently than they reverse, but reversals do happen. It's about odds, not certainties. In the Nasdaq, the same dynamic appeared. Trend tests, breaks, retests, and continuation lower. These structures suggest that until something fundamentally changes, the risk-reward tilt is more toward downside than upside. Near-term support levels might trigger bounces, especially as short positions cover and technical buyers step in, but those bounces may only be temporary unless broader conditions shift. Liquidity tells another part of the story. We're not seeing a full market liquidity crisis where credit freezes and everything stops trading. Instead, we're seeing selective stress. Software and tech stocks, especially those without strong earnings visibility, have corrected sharply. Even companies that reported solid earnings, like AMD, experienced sell-offs as institutional investors trimmed exposure. These moves aren't about poor fundamentals necessarily. They're about managing risk when uncertainty grows. Meanwhile, credit markets show signs of thinning liquidity. Bid-ask spreads in corporate bonds have widened, indicating fewer willing buyers at current price levels. Combine this with volatility in precious metals and cryptocurrency markets, and a pattern emerges. Speculative positions in various asset classes are being unwound. That's significant because when liquidity tightens and risk appetite retreats, markets become more sensitive. Support levels that might normally hold in a liquid environment can get sliced through when buyers are scarce. Structural technical analysis becomes more critical because fewer participants are willing to defend those levels. But the story doesn't end with stocks and bonds. The Treasury market tells yet another part of this puzzle. Long-term yields, particularly on the 10-year Treasury, have been climbing. A rising yield generally reflects one of two things, or both: expectations for higher inflation or increased supply of government debt. In either case, bond prices fall as yields climb. This dynamic is crucial because it shows that market forces can tighten financial conditions even if the Fed isn't actively raising its policy rate. Higher long-term yields raise borrowing costs across the economy, from mortgages to corporate loans, potentially slowing growth further. When you combine a labor market that's losing momentum with inflation pressures that aren't entirely under control, it creates a data environment where markets have to price probabilities, not certainties. We've covered jobs, inflation, and the Fed's bind. Now let's dive into the psychological and structural forces shaping market behavior across sectors. This is where the story gets truly fascinating because the patterns we see repeat across time and across assets, even if the headlines change. Take silver as an example. The recent parabolic move in silver prices wasn't purely about supply and demand. Prices surged from roughly $80 to over $121 in a matter of weeks. Fundamentals alone could not justify that climb. Instead, momentum drove late participants into the market, people chasing gains rather than analyzing economic reality. Leverage and borrowed capital amplified the move, creating a euphoric environment. When the tide of momentum reversed, weak hands were flushed out, producing one of the sharpest corrections we've seen in recent years. This pattern isn't unique to silver. We're seeing similar dynamics in semiconductor stocks, memory markets, and other high-beta tech sectors. Take SanDisk, for example. Its valuation reflects not just strong fundamentals but a projection of those fundamentals extending indefinitely. When markets extrapolate growth in this way, risk increases exponentially. Recognizing this pattern doesn't mean trying to time the exact peak. It's about understanding the risk-reward shift and knowing when discipline should trump speculation. Liquidity plays a central role here. In a highly liquid environment, technical support levels might hold easily. But when liquidity thins, as it has in corporate bonds and certain tech sectors, those same levels can fail abruptly. That's why understanding the flow of capital is critical. It's not about panic, it's about observing where risk appetite is changing. We're also witnessing selective stress in equities. Companies with visible earnings visibility and cash flow, like certain semiconductor players, remain near highs, but volatility is increasing. Meanwhile, software names without such buffers, like Roblox and Oracle, are correcting sharply. These movements are not a coincidence. They reflect institutional money actively de-risking. Even when earnings exceed expectations, stocks can sell off because investors are adjusting exposure, not because the underlying business is deteriorating. This selective de-risking is mirrored in fixed income. Corporate bond liquidity has thinned, and bid-ask spreads have widened. These indicators suggest that while a systemic crisis isn't underway, the environment is less forgiving. Positions that were once considered stable now carry more risk if conditions shift. Bitcoin and other cryptocurrencies illustrate these psychological dynamics in a modern context. Recently, Bitcoin pierced a key support level near $74,000, but didn't close below it. Longer-term trend lines provided technical support, highlighting potential resilience. Short-term, a bounce toward $85,000, $86,000 is plausible. Yet the chart also shows a possible head and shoulders formation, a bearish longer-term pattern. This duality is critical for investors to understand. Markets can simultaneously support short-term rallies while signaling longer-term structural caution. Extreme pessimism in crypto or equities often precedes short-term squeezes, while excessive optimism can foreshadow abrupt reversals. Recognizing these patterns allows one to act probabilistically rather than being forced into a single narrative. Let's connect this back to precious metals. Gold and silver have both bounced from technical support levels identified via Fibonacci retracement and historical zones. Silver's retracement is targeting roughly $96, $102, while gold may approach 61.8% retracement levels near $5.70. These bounces are largely tactical, driven by bargain hunters and short covering. They don't indicate a fundamental shift in the long-term thesis. The long-term case for gold and silver remains intact. Fiscal deficits, geopolitical tension, monetary uncertainty, and the trend toward de-dollarization are multi-year forces that are still in play. Recent volatility was amplified by speculative positioning and momentum trades. Recognizing the distinction between these short-term tactical swings and enduring fundamentals is critical for investors. Even with strong fundamentals, position sizing and leverage management are key. Leverage accelerates both gains and losses, and margin-based speculation often hits the worst points in volatile cycles. Investors who rely solely on momentum are exposed to severe drawdowns, while those who anchor decisions in structural thesis can endure and benefit from temporary disruptions. Cross-asset correlations provide additional insight. The US dollar has been consolidating, neither decisively weakening nor strengthening. This reflects a market caught between two forces: weak growth driving risk-off demand for dollars, and inflationary pressure pushing toward real assets. The result is choppy, indecisive price action across many markets. Equities, fixed income, cryptocurrencies, and precious metals all interact in this environment. Rising Treasury yields tighten financial conditions independently of the Fed's actions. Weak jobs growth suggests risk-off positioning, while inflation and commodity pressures incentivize buying real assets. Together, these forces create a complex interplay where tactical moves may diverge from structural trends. Consider the 10-year Treasury yield, which has continued to climb despite economic weakness. Investors demand higher compensation for lending to the government, reflecting inflation expectations, rising supply, and alternative investment opportunities. Rising yields increase borrowing costs across the economy, influencing corporate capital expenditures, mortgage rates, and consumer spending. The Fed's intended policy impact may be partially offset by these independent market dynamics, reinforcing the unique constraints policymakers face today. We also need to understand the role of market psychology. When assets move sharply based on momentum, it triggers feedback loops. Late entrants chasing gains provide liquidity on the way up, but once that momentum stalls, forced selling accelerates declines. This pattern played out in silver, is visible in semiconductor stocks, and appears in speculative corners of the crypto market. Market participants must reconcile short-term price moves with longer-term structural considerations. Technical support levels, liquidity conditions, and risk appetite provide probabilistic guidance for tactical decisions, but structural thesis rooted in employment, inflation, fiscal policy, and macroeconomic trends determines long-term positioning. Volatility itself conveys information. In high volatility environments, technical levels take on heightened importance. A support level that previously acted as a minor guide can become critical in the absence of liquidity. Understanding these dynamics allows for disciplined, probabilistic positioning rather than impulsive reactions. Recent market behavior underscores the importance of this approach. In equities, trendline breaks and retests indicate where the path of least resistance lies. Short-term bounces are possible, but may fail to reverse structural trends without changes in underlying economic conditions. In precious metals, technical retracements provide tactical entry points, while long-term fundamentals remain intact. In bonds, rising yields and widening spreads show independent tightening pressures that can offset Fed policy. Across asset classes, selective stress, rising yields, and liquidity shifts collectively inform market probabilities. Recognizing when risk-reward balances are skewed, when leverage amplifies moves, and when momentum dominates allows investors to make informed decisions in real time rather than chasing headlines. Even seemingly positive news can trigger technical adjustments. For example, strong earnings may coincide with sell-offs if institutions are rebalancing portfolios. Recognizing these signals is critical to understanding structural market dynamics. To summarize this section, momentum, leverage, and psychology drive short-term fluctuations, while structural forces, jobs, inflation, fiscal policy, and liquidity shape the long-term market landscape. Tactical bounces are opportunities for disciplined positioning, but they must be viewed through the lens of overarching economic reality. Markets are complex systems where cross-asset signals, policy constraints, and investor psychology intertwine. Understanding the relationships between liquidity, technical levels, momentum, and fundamentals enables investors to navigate uncertainty with discipline rather than speculation. In short, whether it's precious metals, equities, bonds, or cryptocurrencies, the key is recognizing when short-term tactical swings are occurring versus when structural trends dictate strategic positioning. This understanding allows for better risk management, less reliance on leverage, and improved survival through volatile periods. Bringing everything together, we return to the central tension shaping markets today. Weak job growth paired with persistent inflation. This combination imposes a binding constraint on the Federal Reserve. They cannot cut aggressively without risking a resurgence in inflation, yet holding tight risks pushing an already stalled economy into contraction. This is the framework through which all current market behavior should be understood. Equities illustrate this perfectly. Trend lines and technical support zones are being tested repeatedly. The S&P 500 recently broke below long-term trend lines, retraced to test them from underneath, and continued its downward movement. This isn't a prediction of catastrophe, it's a reflection of probability. Historically, in similar setups, markets have continued lower roughly 70% of the time. The remaining 30% see reversals, often temporary. Recognizing these probabilities is crucial for positioning rather than attempting to forecast exact price levels. Nasdaq and other high-beta indices display the same dynamics. Near-term support zones, such as 22,000 for Nasdaq, might generate tactical bounces from short covering or bargain buying. But unless economic conditions or Fed policy shift meaningfully, these bounces are likely temporary. Further structural support exists around 20,000, where multiple technical indicators converge. These levels provide guidance for probability-based positioning, not absolute predictions. Liquidity remains a central concern. Selective stress is evident across sectors. Some semiconductors continue trading near highs, but volatility is increasing. Software and speculative tech names have corrected sharply. Corporate bond liquidity is thinning, with wider spreads. This indicates selective de-risking rather than panic. Investors are trimming exposure and reallocating capital, using temporary market strength as an opportunity to reduce risk. Cross-asset connections highlight broader implications. Precious metals, cryptocurrencies, equities, and bonds all show interacting signals. Silver's retracement to $96, $102, gold's bounce near $5, $70, and Bitcoin's short-term resilience juxtaposed against potential longer-term bearish formations all reflect this dynamic. Tactical gains may be achieved, but structural caution remains warranted. The Treasury market demonstrates the Fed's constrained environment. The 10-year yield continues climbing despite stagnating economic growth. Investors demand higher compensation for lending to the government, factoring in inflation expectations, increased Treasury issuance, and alternative investment opportunities. Rising yields tighten financial conditions independently of policy, complicating the Fed's ability to loosen monetary conditions effectively. Corporations face higher borrowing costs, mortgages rise, and consumer spending is affected. This dynamic reinforces the unique structural bind policymakers are navigating today. Momentum and psychology further drive market fluctuations. In silver and tech stocks, late participants chasing price moves amplify gains. When momentum stalls, leveraged positions are forced to unwind, cascading through support levels. Recognizing this pattern allows investors to act probabilistically rather than reacting impulsively. Leverage magnifies both opportunity and risk. Understanding when the market is dominated by momentum rather than fundamentals is key for survival. Sentiment provides additional insight. Extreme pessimism, especially in cryptocurrencies, often precedes tactical rebounds. Conversely, excessive optimism can foreshadow sharp corrections. Observing sentiment alongside technical and fundamental indicators enables probabilistic positioning rather than rigid forecasting. Markets are rarely linear. They ebb and flow in waves influenced by liquidity, leverage, psychology, and macroeconomic data. Corporate earnings illustrate structural versus tactical dynamics. AMD's recent earnings beat, followed by a 10% sell-off, isn't a fundamental failure. It's a liquidity-driven adjustment, reflecting institutional de-risking. Recognizing these patterns is essential to understanding structural behavior across markets. Strong results do not always translate to immediate price appreciation when broader positioning and risk appetite are shifting. Across asset classes, technical levels gain prominence in low liquidity environments. Previously minor support or resistance zones can become decisive points. Equities, bonds, and commodities now operate within these heightened structural constraints. Investors must adjust their positioning, balancing short-term tactical opportunities with long-term structural thesis. Volatility itself is informative. Short-term swings reveal liquidity dynamics, crowd behavior, and leverage exposure. Technical analysis in this environment is not about predicting exact moves. It's about probabilistic assessment and risk management. Identifying when momentum dominates versus when structural forces prevail allows disciplined decision-making. The broader macro backdrop reinforces this approach. GDP may appear positive due to AI-driven capital expenditures, but underlying activity excluding these factors is flat. Employment growth has stalled, inflation is broad-based, and the Fed's policy options are constrained. Markets reflect these tensions, translating economic fundamentals into price action, liquidity shifts, and technical patterns. Understanding markets in this context requires synthesizing multiple layers of information: employment data, inflationary pressures, technical levels, liquidity, sentiment, and cross-asset dynamics. Isolated observations can mislead. Integrated analysis reveals probabilistic insight, recognizing where risk-reward is skewed, where leverage amplifies exposure, and where tactical positioning can supplement long-term thesis is essential. Investors must manage risk judiciously. Over-leveraging, reacting to headlines, or misinterpreting short-term momentum can be costly. Conversely, disciplined sizing, understanding liquidity, and distinguishing tactical swings from structural trends are critical for enduring volatility. This approach ensures survival long enough to see structural theses play out. Returning to precious metals, silver and gold illustrate these principles. Retracement levels create tactical buying opportunities, while resistance zones highlight potential near-term ceilings. Corrections clear weak hands and rebalance leverage. Long-term fundamentals, deficits, monetary uncertainty, geopolitical risks remain intact, emphasizing the difference between temporary volatility and enduring thesis. Cryptocurrencies follow similar dynamics. Short-term technical rebounds may occur amidst long-term structural caution. Sentiment extremes can catalyze rapid moves in either direction. Recognizing the duality between tactical opportunity and structural risk is central to navigating these volatile markets. Across equities, bonds, metals, and crypto, market behavior is a product of structure, liquidity, sentiment, and policy constraints. Understanding these relationships provides probabilistic insight for positioning. It emphasizes discipline, patience, and risk management over speculation and impulse. Markets are not random, they respond to systemic forces, behavioral patterns, and macroeconomic realities. In summary, January's weak job growth and persistent inflation have created a Fed constraint that permeates market structure. Equities test support, Treasury yields rise despite weakness, selective liquidity stress increases, and volatility spans asset classes. Tactical bounces occur, but underlying trends and structural risks remain. Probability-based positioning, technical awareness, and cross-asset analysis are critical tools. Volatility communicates information. Leverage, momentum, and psychology amplify short-term swings, but structural forces, employment, inflation, fiscal policy dictate long-term outcomes. Investors who size positions appropriately, maintain discipline, and distinguish temporary tactical swings from fundamental thesis are best positioned to survive and profit. The key takeaway: markets move in waves, influenced by liquidity, risk appetite, sentiment, and macroeconomic constraints. Tactical opportunities exist, but strategic discipline ensures survival. Recognizing the difference between short-term noise and long-term signals allows investors to navigate uncertainty with clarity. Markets are complex systems. They are not linear, nor are they random. They respond to economic forces, policy constraints, crowd behavior, liquidity, and leverage. Successful navigation requires observation, synthesis, and probabilistic positioning. Reacting impulsively to headlines or chasing momentum exposes investors to unnecessary risk. Understanding structure is critical. Technical levels, liquidity signals, sentiment extremes, and cross-asset interactions collectively inform positioning. Employment stagnation, persistent inflation, selective liquidity stress, and rising Treasury yields define the current framework. Tactical positioning should complement, not contradict, structural thesis. This concludes our detailed look at the interplay between economic fundamentals, Fed policy constraints, market structure, and investor psychology. Markets remain volatile, liquidity sensitive, and influenced by both momentum and structural forces. Probability-based analysis, disciplined risk management, and clarity on tactical versus structural moves are the keys to navigating this environment. We've explored jobs, inflation, technical structure, liquidity, psychology, cross-asset interactions, and the Fed's policy bind. Each layer provides insight into probabilistic outcomes, guiding tactical decisions while reinforcing long-term structural thesis. Markets are not predictable, but they are interpretable when viewed through the lens of structure, risk, and probability. Ultimately, survival and success in these markets require discipline, patience, and understanding. Distinguishing between temporary tactical swings and enduring structural trends allows investors to remain resilient, adapt to changing conditions, and capitalize on probabilistic opportunities. We've seen how weak employment, sticky inflation, rising yields, selective liquidity stress, momentum, and sentiment converge to shape near-term and long-term market behavior. Recognizing these dynamics provides an informed framework for positioning across equities, bonds, metals, and cryptocurrencies. Markets move in waves. Those who navigate them successfully do so by sizing positions for volatility, managing leverage, and interpreting structural versus tactical signals. This is the essence of understanding market structure: probabilistic, disciplined, and informed by both fundamental and technical realities.